Well, one of the most contested provisions of Wall Street Reforms Act is here. It's the so-called Volcker Rule, named after the former Fed chairman who inspired it. 5 years post-financial crisis, U.S. regulators are expected to vote tomorrow on a final version of the rule. It is the element of the Dodd-Frank reform law that is designed to keep some of the nation's biggest banks from trading for their own accounts. Many believe that such proprietary trading by FDIC-backed institutions could put taxpayers at risk if the trades melt down. Joining us now to discuss is Dick Bove. He is a vice president of equity research at Rafferty Capital. Dick, always good to see you. So, much discussion, Sturm und Drang, about this so-called Volcker Rule. But when you really cut to it, how many banks are likely to be affected by it, and how dramatically?
Well, it's going to affect a very tiny number of banks in the United States if it comes out the way we think it is. And you have to realize that they keep changing it. But if they just, were to put it into effect the way we think it is, then J.P. Morgan, Goldman Sachs, Morgan Stanley, to a lesser degree Bank of America, and Citigroup would be affected, and virtually all the other banks in the United States would not be affected. If, however, they choose to put something in there concerning hedging, then the top 100 banks in the United States would be affected, and they'd be affected pretty negatively.
So explain to us that aspect of hedging, because there has been a lot of complaints about that. How does that put these banks at a disadvantage?
Well, it doesn't put the banks at a disadvantage. It puts their customers at a disadvantage. It basically takes away from the customer the ability to lock in an interest rate or to lock in what the cost of a foreign exchange transaction would be. And therefore, it causes less activity in the banking industry, and it causes less trading. But remember, the person who gets impacted by this most is not the bank. It's the person who does business with the bank.
I was speaking last week with one top banker who said that we like to carry in our inventory lots of stocks, lots of bonds, because that's what our customers want. And they would say that, and this person said, that they need to hedge, that they need to trade to protect that large inventory. That's his point of view. Is it legit?
Well, I think it is. I mean, if you make the assumption that, for example, Fidelity wants to sell 1 million shares of IBM, and there's only natural buyers for 600,000 shares, then let's say Goldman Sachs has to buy the other 400,000 shares. If Goldman Sachs cannot hedge that 400,000 share position, it stands to lose a great deal of money or make a great deal of money. But by hedging, it can lock in what the potential gain or loss would be, and therefore they can allow that transaction to occur. Without hedging, the probability of letting that transaction occur at a reasonable price goes away. And therefore, the IBM sale occurs at a much lower price, which affects all prices of all people who are dealing in IBM stock.
Okay. You know, Dick, this Volcker Rule has been debated and criticized from banks to businesses and investors. Does it finally pass? And if so, what does this mean for the individual investor? Does it impact them at all?
Well, for the individual investors in the big companies that I just mentioned, it would have a negative impact. I feel pretty certain about that, because basically it will reduce overall trading in the United States markets. It will have a bigger effect on the average American, however, because if it goes into effect, the probability is that interest rates will be higher than they otherwise would have been. Cost of a loaf of bread will be higher. The cost of a gallon of gas will be higher. It will also result in a great deal of the trading, which makes the United States markets so liquid, will go to Singapore, to Shanghai. It will go overseas. So it'll do quite a bit of harm to the average
quickly,
American.
why is a loaf of bread going to go up because of the Volcker Rule? Very quickly.
Because the price of wheat will go up. In other words, if there's no liquidity in the market for wheat, then basically the price of wheat goes up. This bid and the offer in the wheat market spreads, causing higher prices for wheat, which causes higher prices for bread.
All right, Dick, thank you very much. Dick Bove, Vice President of Equity Research at Rafferty Capital.